mic's still off, but let me know when it pops up. 5 minutes. Yes. Cool. Everywhere. Oh no. Also, there's like a 10-second delay. So. This thunder. I don't know how to tell how many people are in this. Cool. I did not. This is weird. Don't know. Oh, now I see it. There it is. Okay. All right. I'll turn the mic on and just talk a little bit for the next couple minutes. All right. Hey everybody. So I see some people are joining in. Welcome. We got about 2 minutes before we kick it off. So hang in there, say hi in the comments, or not. It's fine. And anytime you have questions, you can put it in the comments, and eventually I'll get to them. Hopefully I can answer some of them. Okay. One more minute. Hopefully it sounds okay. and this halo thing behind me on the side. It's like it's a light. So yeah. Okay. So I'll go ahead and get started. So hey everybody, Chris here. Today we're going to demystify the 401k and mutual funds. Disclaimer, I am not a financial advisor and this is for entertainment purposes only. It's suggested that you do your own research, but I will try to provide as much information as possible that I know and I figure it out myself. So the first thing is that many of you are probably working and have 401ks. You've probably sat in some presentations before with a lot of mumbo jumbo. And, the truth is, at the end of the presentation, you're given a form, something very similar to this, where you look at it and you're like, wow, there's 50 items on here. What am I looking at? And how do I pick what's best for me? And sure, you could talk to your company's 401k representative, and they'll go through a lot more things. But at the end of the day, their job is to sell you on a fund. So they they may have your best interests in mind, but uh, they're working for their company while you're the one that's looking out for yourself. So this is what I'm here to help you try to figure out what is best for yourself. And it varies from person to person. So I want to give you all the knowledge and information that you need and can figure things out for yourself going forward. All right. So let's start with the presentation. Okay, demystifying the 401k fund. All right. Let's see. Oops. There we go. All right. I'll start off with a quick history in a minute. So once upon a time, you worked for a company for 20 to 40 years, and then you retire at 60 and you paid for the rest of your life, sometimes up to half of your working salary. This concept, it actually comes from ancient Rome, where the soldiers would be paid what is called a pension for their service once they're leave the service. Now the first corporation started in 1875 by American Express, and by the 20s, many large companies have started offering these private pensions. Now prior to this, most businesses were very small and they were family run, so this was like a completely new concept for the corporate world. And companies did this because contributing to the pensions was a tax write-off for these companies. Now, over the next couple decades, this kept gaining popularity, and by 1950s, 25% of the private sector of the workforce had a pension, and then this rose to more than 40% by 1960. Now, the problem is that pensions, because they weren't very heavily regulated, they started crashing in the 60s and early 70s. So in 1947, the Congress passed the Employee Retirement Income Securities Act, and in 1978, the Revenues Act, which gave birth to the 401k. Now, the 401k, it was a way for higher paid employees to put away more money that was sheltered from taxes. For everybody else, it was sold as an idea to supplement pensions. Now, keep in mind, it was never intended to replace it. And what the 401k did was it shifted the defined benefits, as in the set amount you would get once you retire, which was dictated by the employer, and it shifted that into defined contribution plans, which the responsibility of retirement of it became the employee's responsibility. So now you're in charge of your own future, and the company is only providing a plan, the framework for it. All right. Next thing, history in another minute. I don't know how quick or slow the previous section took, but funds, the other half of what we're talking about here today. So basically, a mutual fund is a set of pooled resources to diversify and reduce your risk. In other words, you don't want to put all your eggs into one basket for for your future and your investments. Now, in the 1920s, the Roaring '20s, where economy was going really well, hundreds of mutual funds were created. But as you may know, in 1929, there was a big stock market crash that started off the Great Depression. And the government stepped in with the Securities Act of 1933, which formed the SEC, which is a Securities Exchange Commission. And the main purpose of that was to, in regards to mutual funds, is so that all mutual funds needs to be registered and then provide a disclosure document called the prospectus. We'll get more into the prospectus in a little bit. So after the 401k passed in 1978, mutual funds, this thing really took off in the 80s and the 90s. But the truth is that between 1984 and 1999, which is a 15-year span period, 96% of actively managed mutual funds did not beat the market itself. So, a lot of work put into it. All these people think that they could beat the market, but the truth is the vast majority of them just cannot outperform the market. All right, as promised, we will go into the definitions of most common terms you'll hear on your 401ks, investments in general, in mutual funds as well. So the first thing is stocks. What is a stock? Basically, a stock is ownership in a company. This is important to keep in mind that you're not just trading anything you need to be aware that the stock is actually related to a company, and as buying a stock, you become an owner of that company. Now, the price of the stock is actually dictated by what people think that stock is worth and is willing to pay. Now, stocks are traded in shares, which you can think of it as a piece or unit of ownership. Next thing is the index or the benchmark. There are very many popular indexes or indices. The most popular you may have heard of is the S&P 500, which is the Standard & Poor's 500, which is a basket of 500 very large companies in the market. And another popular one is the Dow Jones Industrial Average, which is selected by the Dow Jones company, and it is 30 stocks in 30 companies within this basket. Another one you may also hear of is the Russell 3000, which is 3,000 of the companies on the U.S. market, which makes up about 98% of the entire U.S. market. So, when we talk about the Russell 3000, it's pretty much the entire market. And the word benchmark, we're talking about, the baseline, or not even baseline, where you want to hit the high point of the market that you want to achieve. When we talk about how actively managed funds are trying to beat the market, this is what they're talking about. They're trying to beat one of these indexes. Next thing I want to mention is that there are stock markets across the world. They'll be phrased as domestic for the U.S. and international for anywhere else. The general rule, or what people are saying, would be that the domestic stocks or the domestic market is a little more stable, and the international one has a little more risk, more volatility, but there's also more room to grow. So that's one of the things why people would like to invest in international stocks. Really quick, you may also hear the term blue chip, which just generally means it's a high quality stock. When you hear, and the term comes from casino chips, which blue was the highest value color over red and white. When you hear of a blue chip company, is a very high quality company. It may not be the most expensive stock, for example, but it is of a high quality, well known brands you've heard of. So that's just what that means. A couple of the other terms you may hear is capitalization, which just means the total amount of money with all the shares multiplied by the value of the share. So how much a company, all the shares put together is worth. So, and then the size is for a small cap is 300 million to 2 billion. Mid cap would be 2 billion to 10 billion, and a large cap would be 10 billion and higher. A little bit about what this means is that a lot of the large cap companies, they are very well established. They're pretty much most of the time are finished growing at a very high rate, but they're also very safe. And then as you go towards the smaller cap, they have a lot of room to grow. So, but they're not as established. But as you can see, from a 300 million to a 2 billion capitalization, these small cap companies are still very large. Now, the next thing I want to talk about is some of the strategies that you may hear words tossed around, and these are actually very self-explanatory. For growth stocks, they are companies that are looking to grow, through innovation or acquisitions. Value is also fairly self-explanatory. It is when the stock price of a company it is lower than what the company is worth, hence a higher value. This is a very popular form of investment. Most notably, Warren Buffett is very much into the valuation strategy of stocks. And finally, we have a dividend strategy, which what a dividend is, it is a profit sharing for stockholders, for shareholders and investors. Now, the money, what you may ask is, why are companies paying out dividends to stockholders? Well, this is the money that the companies can't use to grow. Now, a lot of these are very specific. Very notably would be utilities or oil companies that if they take all the profit, they're not going to buy more infrastructure or anything like that to increase the size of their business. And then as a result, they take all the extra profits and then they sit out as a dividend to their shareholders and investors. Important thing to note is that dividends are not guaranteed because at any time, as we can see, a good example would be Delta Airlines. They've been giving out dividends for a very long time. However, with this pandemic happening, they were forced to actually cut their dividends, and a lot of people sold Delta as a result. Next, we're going to talk about what are bonds. So bonds are debts. Companies and governments also need to borrow money to, invest and grow their companies or expand or use it for acquisitions, build infrastructures, all these reasons. So basically, when you own a bond, it means that you are owed money when that debt hits maturity. Now, the problem with bonds is that there are risks, and the risks are that they are fighting inflation, and that is the key thing you want to keep in mind. So bonds, typically, you'll see that they have a term associated with it, a duration. Now, the short-term bonds are less than 2 years, 24 months. Mid-term bonds are around 2 to 10 years. Long-term bonds are 10 years. Now, this is a little bit different because the bond safety also depends on how well the company or how much you trust the government fund from defaulting or unable to pay. So, for example, the U.S. bond is pretty safe. The only way that the U.S. won't pay your bond is because if entire government failed. Now you compare that to like Venezuela, for example. That's Venezuela bond is probably worthless because the government can't pay anything of it because the government has failed. Um, one of the good things about corporate bonds is that legally, as a bondholder, you are paid before the stockholders. So you have a little more tips. But of course, if the entire company goes bankrupt and fails and shuts down completely, no one gets paid. So these are all the risks of investing in bonds as well as stocks. Okay, so that was a mouthful of definitions and a lot of things. And as we go forward, these terms will come up, and I'll expand on them, and hopefully it'll be a little more clear. Okay, so what to look out for. First thing that I want to call attention to is expense ratios. Now, these are basically the fees that are associated with somebody has to manage these funds. Now, when we were talking about mutual funds, it was basically a basket of securities or investments that somebody had to put together into one as part of the diversification. So there are two main examples of this. First is the index, which is due to technology, is mostly passively managed. So as a result, these expense ratios are relatively low. On the other hand, when a fund is actively managed, excuse me, it is manually picked by somebody called a fund manager, and they actively go and look at the basket of investments, and then they decide how much of what to put in there to maximize their the gains. Next thing, like I briefly touched upon, was diversification. There's a couple of ways to diversify, and the reasons you want to do this is because of uncertainty, and there's some things are not correlated. When one goes up, one may not be affected at all. Whereas if you all have it in the same category, everything will move together. So you want to look for some things that are in different asset classes, which means that bonds do not necessarily move at the same with the same movement as stocks, for example. And another one would be real estate. These three, they may have some effect on each other, but they do not have direct correlation to their movements. And then that's why you would want to have diversification across asset classes. Another way to diversify is across sectors and industries. For example, one industry that has crashed completely from the pandemic is cruise ships, like Carnival and Royal Caribbean. Those stocks have all plummeted, and basically because there was a global shutdown, no one can go on cruise ships, so the companies cannot make any money. So you want to make sure that you're not too focused into one particular sector or industry in case something like this happens. And finally, another way to diversify is across different companies. If you hold all your investments in Apple, and one day something terrible happens to Apple, you would lose all your money. So you want to make sure that it is not focused just on one company. This was an issue back in the day when there was a lot of stock profit sharing, where employees would get stock in their own companies. However, after they retire, if that company goes out of business, all of those stocks become worthless. Now, there's good news because, as I mentioned before, the indexes, it covers a wide variety, and it is very good diversification across all stocks. And finally, what to look out for is this is a very good rule in life, is to follow the money. Now, when you're looking at an investment you want to see where the money is coming from. How is the investment getting the returns? Now, for a stock, as I mentioned, you're buying a part of the company. So how does that company make money? How does it make profits? And what does it do with its money? Now, these are the things you want to look out for of when evaluating how good a company really is. They may be a well-known brand, but if you look at it and they're like, oh, this is very questionable where they're throwing money away or something like that, this you would have to think twice before buying stocks into that particular company. So, and for bonds, for example, you know that they are debts. So, like I mentioned before, if it's very heavy on the U.S. government bond, you know that the U.S. government is a relatively safe investment. If it is a corporate bond, you want to know what those companies are doing with their money, very similar to stocks. And finally, the other asset class of real estate, there are funds with real estate um, collections, and they're called REITs, real estate investment trusts. And obviously, the money that comes from that is by their rental properties. So you would want to see what kind of properties they invest in. Okay. Now, how to pick the right investments for you. This is a very individual thing, but there's a couple of things that I want to share. And the first thing you want to keep in mind is your time until you retire. So what you need to know is that the stock market is a long-term investment. And we're talking long-term as in at least 10 years. Now, as you approach retirement, you want to look for lower volatility and more of a fixed income, because really that's what retirement really is that you're no longer actively working for your money. So you need some sort of income. And a way to get this more steady, low volatility stream of income is through when you change more of your investments into bonds and into dividends. And again, when you do this conversion, you want to again follow the money. For example, bonds, because of the um, it is a contract you borrow. The company is borrowing money, and then you buy that debt, and so they're going to pay you when the time comes. And also dividends, when the stable companies, they are putting out dividends as part of their profits. Um, you have a set. Again, dividends is not guaranteed. However, there are companies that do provide a steady dividend. So the next thing you want to pay attention to is your own personal risk tolerance. Now, what this means is basically how skittish are you when it comes to the investments going up and down. Traditionally, or historically rather, stocks do have a higher volatility, but they will always have a higher return in the long run. So a hint is that when you're investing, don't worry too much when the market price drops, because it will always drop, and then it will always rise again, and it will always be higher in the long term. And again, long term, we're talking about at least 10-year period. There hasn't been any 10-year period in the stock market where investments haven't gone up in the stocks. Finally, we want to talk about fees again, because this is the number one thing I want everybody to be aware of. This is your money. You worked hard for it. You want to keep more of it. So you want to make sure that your fees aren't being chipped away at by these investments that you're putting your money into. Okay. So I think that was a lot of information. What we're gonna do next is I'll show you again this little example of let's not do that. That's okay. All right. So this is from what's going on? Yikes. Bear with me. Okay. All right. So this is the example that we have of Mutual of America. This is a real um, set of mutual funds available to pick from. Uh, so when what you want to do when you get something like this is you want to look at them individually. You don't have to look at all of them. From our definitions we looked at earlier, where we talked about, let's put that up again. There we go. So from these, we talked about the capitalization and strategies, differences between domestic, international, and also bonds versus stocks. So these are all the things that we kind of want to use our knowledge of to decide what to even look at in the group of mutual funds. So here we are. All right, so we'll go and look at the first one, which is the Mutual of America Equity Fund. So do this. Okay. So basically in a browser, we do a search for it and we find it. And then as you can see, it says that this fund seeks investment results that correspond to the investment performance of the S&P 500 index. So like I said earlier, that indices are mostly passively managed, so they are cheaper. And also from the previous stat I noted or cited, 94% of actively managed funds actually can't beat these indexes in the long term. So why pay more when it doesn't, most of the time, it fails to produce better results? So this is one of the things that you need to be really cognizant of when you're picking your mutual funds. So again, you want to go further, and it says basically this fund primarily invests in the 500 common stocks included in the S&P 500 to replicate and to the extent practicable and weighting of such stocks in the index. Yeah, so like this is really boring stuff. Basically, what this one is trying to do is trying to match the index. On this page, a lot of words and things. What you want to look at, they do tell you the performance data. Now, I would be very skeptical about this stuff because, for one, past performance does not indicate how it's going to do in the future, because literally it is taking data from the past. The stock market is it's like a living thing, because the people that are buying and selling stocks are all people, and people are very unpredictable. So that's one of the things that you want to consider for your own investment as far as volatility goes. Like again, I said, how skittish are you when it comes to this kind of things? When you see price fluctuate up and down, are you going to freak out? Are you going to sell? So those are the things, and people do freak out and they sell and they do illogical things. So you don't want to be one of those people. You want to be logical. So be very careful looking at this type of stuff. Next thing you want to look at is you want to look at the actual prospectus. So this is the document here. I click it, and this is the actual document itself. Now again, this is a more in-depth, and this is what's filed to the government. So this is everything that is in the fund, and what the fund's doing, what it's trying to do, how much it's costing. So you want to scroll down until you see this, which is the total annual fund operating expenses. And this comes out to 0.13. just as a reference, if you go and buy the Vanguard version, I think it's VOO, maybe, could be wrong, but that one has a 0.03%. So as you can see, this mutual fund is way more expensive than if you go out and try to buy it on yourself. Now, the reason why this is 0.13, obviously, as you can see, other expenses, 0.05, this is more in line of what it really should be. However, there's a very high management fee because at the end of the day, these mutual funds is linked to your 401k, so a company has to manage this, and they're also managing it through your employer who's running this 401k program. So that's why there's all pretty much all 401k mutual funds, they have a higher expense ratio total. So you look at this is 0.013, which already, in my opinion, is kind of high. But you don't really have a choice because this is made by your employer and the 401k company. Lucky us. So we looked at this first one and we saw that the expense ratio is 0.13. And again, this is the index that is trying to match the S&P 500. Next fund we're going to look at is, what is this All-American Fund? Well, I have no idea what it is. Let's take a look. All right, so actually, yep. So this is the All-America Fund. Again, it says it is, now this one seeks to outperform the S&P 500. So this is a little more active, hands-on. It is still trying to use the index as the benchmark to try to beat. So if we compare these two, this one says that it is using 60% of matching the S&P 500, whereas the first one we looked at, it was using at least 80% of the fund to try to match the S&P 500. So that's basically the difference between these two, is that the first one is trying to match at least 80% of the index, and then the second one is trying to beat the index, but still also matching about 60% of it. Basically, it means they're putting in more work to try to beat the market. Now we scroll down to the perspective of the second one, and you see that this one is much, much higher, up from 0.13 up to 0.49. So in my personal opinion, this will be a hard pass because I don't trust fund managers. A note about fund managers is that there are ones out there that do consistently and over a long period of time beat the market. They're known as unicorns because they're almost impossible to find. Maybe are impossible to find. But one notable one, actually, I don't remember. Anyways, in the book, this book, Me, Master of the Game by Tony Robbins, he talks about one of such unicorns that is really good at managing and consistently beating the market. And with this kind of skill set comes a very high demand because people with a lot of money want to put it somewhere where it could ensure that it grows and beat the market. So, for example, this particular fund manager, he won't take investments less than like $500 billion. And this is what basically it takes and how rare these people are that are able to consistently beat the market. You know, and the only way you have access to these kind of people is with that much money. So we are not those people. So we basically, what's best is to try to reduce your fees and look at the which ones you could, which indexes that are right for you and that is available to you in your 401k. So now just for funsies, we'll look at some of these other ones. So we got, oh, sorry about that. I think we were, There you go. So this was the All America Fund, which was the 0.49 expense ratio compared to the first one we looked at, which was the index of 0.13. The next one I pulled up was the total bond market index portfolio. And this one is by Vanguard, so the perspective looks a little different, but it generally has the same information. We'll just ignore all this, scroll down. Here we go. And this is the operating expense ratio total, 0.14. Again, in general, bonds have a lower total return than stocks because if you think about it, bonds are what companies and the government is borrowing and returning. Not unlike, for example, you borrow money to buy a house or a car or anything else really. So it is the terms are discussed and fixed upon the time of the borrowing, whereas stock is directly linked to how well a company is doing and how fast it can grow. And historically, stocks always outperform bonds because companies grow way faster than the amount of money they borrow and return. Makes sense. Otherwise, why would companies need to borrow money if they can't make a lot more money back? So that is the bonds index that we have available on here. A note on retirement funds, as you can see on this chart, we got a whole selection of these, and they all have the same expense ratio. But basically, what it's looking to do, and I'll show you right now. Okay. Okay, so what it's doing is at that target date, and they have one for every 5 years, they changed the allocation type between the equity and the fixed income funds. So again, to repeat, equity funds, they're basically talking about stocks, and fixed income funds, they're talking about debt types, such as bonds. And fixed income, it also incorporates REITs, real estate, because real estate is rental income, so it's also fixed. So once again, we'll click the prospectus and take a look on the inside, and you see that is 0.34. Again, this makes sense compared to what we were talking about earlier, is that the more active it is, the more someone has to go in and manage this fund, the more expensive it's going to cost. Fees are killer. The last one, just want to pull up for fun, is the real estate index portfolio. So what it's looking to do is to seek high level of income, moderate long-term capital appreciation. Yeah, I fell asleep reading that. So, okay, so this is the perspective of it, and again, we want to kind of take a peek at those. Here we go, 0.26. So basically, out of all these funds that we're looking at, the two that you should really take a look at is the what are the names of it? It was the equity index fund, which is looking to match the S&P index, and also the bond index fund. And between these two, they have, out of everything on this list, have the lowest expense ratio, and you just don't want to pay fees. It's coming out of your pocket. So the first one is 0.13, and the bonds index one was 0.14. So now you have these two in mind. Depending on when you're looking to retire, you would want to allocate different percentages. There's a lot of school of thoughts, and really, it'll come down to what you're comfortable with. You'll hear a lot of rules of thumbs between 80% stocks, 20% bonds. There's another school of thought going 65-35. There's also ones going 60-40 or even 50-50. And generally, as you approach retirement, you will want to shift more into the bonds and the fixed income ones because you want more consistency, less volatility, and you just don't have as much time to ride out those waves, although they will, in the long term, be more profitable. So, if you have any questions, concerns, go ahead and type your comments. I know this is a lot of information. Thank you all for joining. Wait a few minutes, see if you have any comments or questions. In the meantime, I want to give a shout out that this particular mutual fund document and the request came from my sister-in-law Megan, who happens to have her birthday today. So if everybody in the comments puts "Happy Birthday, Megan," it'd be great. See any comments? Nope, not yet. Oh, nice. Okay, so we got a question. Would choosing the equity and bond funds separately compare to the retirement funds? Okay, so let's take a look back at what those retirement funds actually do, and then we can kind of decide whether it's worth it for to pay the higher expenses of them managing it. All right, let me pull that up. All right, we did that one. Okay. Very good question. Very good question. All right, so we can look at what this one is doing. This is the breakdown as of last December. You can see that 40% is in the index equity fund, which is the S&P 500. It is taking 20% in the mid cap, and small cap another 10%, actually 12, 13, 14% in small caps, and then also some in international and bond funds. What this tells me basically is that it is diversifying your portfolio quite a bit through all these different factors. Now, it is up to you and to decide if this is worth it for you. Personally, I would say no, and the reason again is that all these combined is just not gonna beat, 100% equity fund. If you're looking to retire, more than 10 years from now, it's just not. I would say And here's my reasoning for it. Bonds, you may want some exposure to. As for everything else, international, it's up to you, your opinion, if you feel that the world's stability or growth and safety is worth it to you for your investments. But basically, as for small cap and mid caps, these are all, I would say, trying to the market. And although past performances don't dictate how much the future performance is going to be, there's it has never been the case that, or I shouldn't say that, it's almost impossible to beat the market for uh, from a actively managed portfolio fund. That said, is every one of these, you're introducing a human factor of what the fund manager thinks is going to beat this market. So every time that somebody touches this and puts in some of the allocation somewhere else, it's a risk. These are the risks that people really aren't talking about. But as you can see, this one has all these different things that each one of these factors, somebody could screw up and just mess up or guess wrong. Um, and I don't know how often this is reevaluated. There's probably somewhere here in the prospectus. But if you think about it, you're rolling the dice every time somebody is looking at these things and changing the allocations. Whereas what you want to do is you want to put money in there long term, don't touch it, and have it ride the waves up and down. And because it will just go up and up and up long term. And that's the the main reason why I am not really a fan of these retirement target dates. The bonus is that as you approach retirement, what these allocations will do is they'll shift less and less from the equity. This will drop, and actually, let me read that. The small cap ones will drop because these are trying to grow your investment because they have more growth potential, being smaller companies, but they're less safe. So it'll probably go from the small caps and the mid caps more towards the bond funds. So that's what this thing will do. Yeah, that makes sense. And yes, the retirement one has more fees because they're doing more things to it. Uh, the fund manager is looking at it more and trying to beat the market, which they won't long term. They may short term, long term. Sure, they may get lucky, but I wouldn't bet on it. Not with my money. If you want to bet with it with your money, go for it. But I wouldn't with my money. And one of the things is that because this is long term, not everybody cares too much about all this details and things like that. You just want to know the basics. You want to make sure that you're picking good choices for yourself. You don't want to get screwed over. So um, it's good to kind of spend a little bit of time every 6 months or even like every year. Kind of look at where your money is parked. You don't really have to really touch it. Um, but it's good to know who's managing your money, what it's doing, because at the end of the day, it's your money. And the thing is, if you give it to somebody else, they're gonna do what's better for them, not necessarily what's best for you. There's a term called a fiduciary, which is a legal obligation to do what is best for the client. Um, I think for a 401k program, your employer has a fiduciary responsibility to do what is best for the employees. But again, these people, your bosses, your CFOs, they're probably know just a little bit more than you. Um, in fact, after if you absorb all this stuff in the presentation, you might know more than the person in your company that's picking out these 401ks uh, uh, programs. And again, so the 401k company, they're not legally obligated to do what's best for you. They're selling a product, and the product is uh, all these funds. And from as you can see from those expense ratios, basically those fees goes towards paying for the 401k company. It goes towards paying the fund managers that are actively trying to beat the market. Right. So I'm pretty sure almost nobody's looked at prospectuses unless they're actively invested in the stock market, or rather, I would say they're interested in it. Usually, you don't really care. And when you meet with one of these 401k advisors or retirement advisors, again, you got to follow the money. Who's paying them? Are they legally obligated to recommend what's best for you? No, they're working for the company. And the other thing, to be honest, they might not even know what's best. They might not have the best plans for themselves. They're just working within the system that they know and what they have in front of them. If anybody has any other questions, comments, please go ahead and type it down there. Or if there's any subjects that you would like to see in the future get covered, go ahead and let me know. Put in the comments. Send me a message. Okay. Okay, so um, thank you everybody for joining in or watching this on the rerun. Again, if there's any future content you would like to see, please go ahead and leave it in the comments, and hope everybody has a good day.